for joining for another session. My name is Anne. I'm a tutor here at First Intuition, and I'm in the process of taking you through the First Intuition mock number 1 as part of our revision sessions. The unit is Tax Processes for Business, and Finance Act 2024 is the current Finance Act that we need to be understanding, and today we're going to look at task 5 on verifying VAT returns. If you haven't already looked at task number 1, that might be something that you would like to do. We talk a little bit more in task 1 about the mark allocation through all the tasks and how the FI materials work, so that could be something useful as well. So this particular task is verifying VAT returns. It's 12 marks, so one of the longer tasks in your assessment, giving you about 14 minutes for this one. So what sort of things are going to be in here then? Identifying where transactions should be included on our VAT return. Errors, how to correct them. Talks about thresholds for reporting of errors, and then reconciling the trial balance VAT control to the VAT return. The reference material is particularly helpful on the area of errors. Error reporting thresholds are in the reference material, so I would definitely consult it for that. So here's our example. Let's give it a go. Andrews Architects uses accounting software to calculate the VAT due either to HMRC or from HMRC. If VAT is due to HMRC, then that would be a liability. But if VAT is due back from HMRC, that would then be an asset. They don't use any sort of specialist scheme, and the accounts assistant, who reviews the VAT return for the quarter to October, passes it on to the accountant for approval. So here we are. We need to identify whether the following transactions should be included in box 1 or in box 4 of our VAT return. Box 1 is where we include our output VAT, so the VAT on sales, the VAT that needs to be paid to HMRC, and box 4 is the input VAT that we are going to reclaim from HMRC. So for now, all we're doing is saying, is this a VAT relating to sales, or is it VAT relating to purchases and expenses? It's not asking whether the amount is going up or down. It's just saying input or output VAT. This is credit sales. Sales will actually increase the amount of VAT owing, and they will go into box number 1. Purchase debit notes are like a credit note but for purchasers. So because they're for purchasers, they are box 4. They'll actually reduce the amount of input VAT. Question didn't ask us for that, but because it's a revision course, why not? And our credit sales would increase the output VAT. VAT on goods taken for private use. If you have a little shop, you are hardly going to go to Tesco and buy milk there when you sell milk in your own shop. So you are going to buy goods from your own little mini mart. But as far as HMRC are concerned, you have to sell those goods to yourself at the full price. So if you take goods for yourself, VAT will be included. You have to account for that sale. So we would increase the output VAT. When you make a sale to yourself, that VAT must be paid over to HMRC. So that is a box 1. And then VAT on the import of goods accounted through postponed VAT accounting. There is a section in the reference material about international trade. And the import of goods is dealt with under postponed accounting. What it means is that as the goods are imported, so the goods arrive in the country, it is responsibility of the UK taxpayer to include the VAT on those goods in both box 1 and box 4. So there is no overall effect in terms of extra VAT to pay or reclaim VAT is added into box 1 and 4. So we increase both boxes. And that's worth 5 marks. Because the last one was a little bit of a trick question, because it needs to go into both. We've now got the accounting software used by Andrew, architects, to calculate the VAT due to or from HMRC. But the software has recently changed, and the accounts assistant has done a draft VAT return for the quarter to October. But the accountant has asked them to complete a reconciliation to the trial balance just to check everything's fine before we push the button and submit our VAT return. So the VAT return itself has these figures in. And the VAT liability in the trial balance, as at October, has a balance of 47,120 and is put together like this. Goes on to say the trial balance includes closing receivables of 124,800, all include VAT, and it includes closing trade payables of 10,320, all including VAT. Identify the reason for the difference between the VAT due in the draft VAT return and the figure on the trial balance. So what could have happened here? What has gone wrong? Box 5 shows us the VAT due. So box 1 is the output VAT. Box 4 is the input VAT. Box 5, in this case, is the VAT payable to HMRC, but it can also be the box where we jot down VAT that we will recover from HMRC. So output VAT is sales, input VAT is purchases, and then we have the VAT payable to HMRC. Down here, we then have what we call net outputs. So that's our sales without the VAT included, and then our net inputs. So purchases and expenses without the VAT included. And I think before we can really answer this question, it is a great opportunity for us to actually revise the different boxes of the VAT return. So let's see what actually agrees with our T account and what doesn't. So our output VAT, we have 32,800. And yet the VAT control account has 53,600. So it's showing a lot more VAT. Input VAT, 4,760. This one's showing much more. So what's happened to my VAT control account to mean that I've got so much more output and input VAT in here than I've got in my actual VAT return? I'm not worried about the brought forward balance because that was an opening liability, which is then settled for cash. So that's not the issue. The issue is that the VAT return has so much more output and input VAT in it than I would be expecting. But this little sentence then definitely gives me a clue that the trial balance includes closing trade receivables, totaling 124,800, including VAT. So let's find out how much VAT would be included in there. $20,800. And closing trade payables, 10,320, multiplied by 20, 120, 1720. So do those figures account for the difference maybe? Let's look. 20,800 of VAT and receivables would make the total output VAT 53,600, which would then agree. The VAT on the trade payables of 1,720, if I add that on, then it would give me the VAT in the VAT return of, or in the VAT control of 6,480. So the question is, what's actually wrong here? It's suggesting something is wrong with the software. So these are the correct figures. because the options tell me the software is incorrect, the software is incorrect, or the software is incorrect. It's incorrect for one of three reasons. So the VAT control account itself is fine. The software isn't. So what the software seems to be doing then is including the input VAT on just the bit that's being received, because remember the other bits are still outstanding, either trade receivables or trade payables. So that's the VAT on the payables, hasn't been paid yet. That's the VAT on the receivables, so hasn't been accounted for yet, haven't been received from customers yet. So what the software seems to be doing is incorrectly using cash accounting, because cash accounting would say, I only want to account for the VAT on the bit that's being received. So if this is outstanding as payables, that doesn't go in my VAT return yet. And if this is outstanding as receivables, that doesn't go in my VAT return yet. So they've included only the part that has been actually changing hands as cash. So the software has been incorrectly set up for cash accounting. There's no percentages given here or anything to suggest that we're using flat rate accounting, and annual accounting just means doing one VAT return. So you could maybe have come to that conclusion without even doing all the numbers, but I just wanted you to have a more in-depth understanding of the topic, because it is a revision course and we never know what the next question might hold. But you can see clearly here, the software is the problem. The question tells me that, and the software does not include any of the VAT on the receivables or the payables figures. And there's my problem. It's dealing with cash accounting, even though we're not in a cash accounting scheme. Okay, complete the table to reconcile the figures now. Use a minus sign or brackets where applicable. So I need to say the amount due per the VAT return is 28,040, but I was missing the output VAT on the receivables. So the draft VAT return says 28,040. I need another 20,800 to be added on to get to what the trial balance says. And then I deduct the input VAT on payables because that gets reclaimed. Which was that one? 1720. And then that would then agree to the trial balance. Bit of a strange way to reconcile it really, because the VAT in the trial balance is actually wrong. The VAT in the VAT return is correct. So maybe we should have started with the VAT liability in the trial balance and then reconciled to the VAT return. But it doesn't really make any difference. The point is that you understand why the two are different. And we know which is the right one. The software is incorrect. Okay. So that brings us to the end of that task. Join me shortly. We'll have a look at the next one, which will be task 6.